welcome back to Economic Insights. I'm Alex, your host, and joining me as always is Selim, market veteran, show producer. Selim, we're doing something different today. Instead of just the weekly recap, we're taking a broader look at what 2026 might bring for global markets.
That's right, Alex. Though we'll start with last week because, as always, recent events are already shaping those 2026 expectations. And it was quite an eventful week.
Let's dive in. What made this week so eventful?
December started with Japan throwing a curveball. Governor Ueda made comments that were virtually identical to his deputy's earlier hints about a rate hike. Markets took the hint. A December hike is now basically locked in. Japanese 10-year bond yields hit their highest level since the global financial crisis, and that reverberated globally.
How bad was the spillover?
US and European bonds sold off sharply. Treasury yields jumped the most in nearly 4 weeks. You had the US ISM manufacturing data suggesting stagflation. Suddenly, Bitcoin's down hard, and equity markets are retreating. The S&P 500 and Stock 600 both snapped 5-day winning streaks. Not the December cheer anyone wanted.
But things calmed down midweek.
Markets are resilient when they want to be. Bitcoin bounced back with its best day since May. You can't keep crypto down for long, apparently. There was some diplomatic progress with Trump's envoy meeting Putin in Moscow. Constructive was the word used, though no actual breakthrough on territory. And in the US, the Fed chair selection moved forward, with Kevin Hassett being mentioned as a potential candidate.
The inflation data from Europe, that must have been important too.
Euro area core inflation ticked up slightly to 2.41% year on year in November, pretty much in line with expectations. Services inflation remained elevated at 3.46%. But the month on month core momentum actually slowed, partly thanks to German package holidays providing a negative seasonal adjustment. I love how something as mundane as vacation pricing shows up in continental inflation dynamics.
And emerging markets? Turkey's inflation numbers came out too, didn't they?
Turkey provided a pleasant surprise. CPI eased to 31.1% year on year, below expectations, driven by an unexpected drop in food prices. Month on month was just 0.9%, reversing the food inflation surge we'd been tracking. But, and there's always a but with Turkey, core inflation didn't improve much, so the central bank will likely proceed with a 150 basis point cut.
China's data continues to look concerning.
China's in a tough spot. The manufacturing PMI contracted for the 8th month in a row. That's a record. Services PMI actually fell into contraction for the first time since December 2022. New home sales in major cities dropped 33% year on year. All the stimulus announcements haven't translated into actual demand recovery yet. Either the measures need time to work, or they're simply insufficient given the property market headwinds.
The week brought some confusing jobs data from the US.
ADP showed weak private payrolls. ISM services showed pricing pressures easing. Markets were confidently pricing in Fed cuts. Then weekly jobless claims dropped to 191,000, completely blindsiding expectations, and suddenly 2026 rate cut bets are being scaled back. Treasury yields popped to a 2-week high. It's a reminder that this data is noisy and you can't extrapolate too much from any single print.
India was one of the positive stories, cutting rates.
India's in a good place. The RBI cut rates by 25 basis points unanimously, bringing the repo rate to 5.25%. Their inflation outlook is so benign that inflation actually breached the lower tolerance threshold, first time since they adopted inflation targeting. Meanwhile, they raised their growth forecast to 7.3%. That's the kind of setup central bankers dream about: low inflation, strong growth, room to support the economy.
Okay, let's look forward. What's the big theme for 2026?
This is where it gets fascinating. The major investment banks are arguing that AI becomes the dominant macro factor next year, more important than monetary policy, more important than trade policy. The idea is that AI capital spending and adoption creates this powerful positive feedback loop that supports asset prices even if other factors deteriorate. It's a provocative thesis.
Are we really at the point where AI matters more than central banks?
Well, that's the bet. But let's talk about the risks because they're substantial. First, AI driven equity valuations could correct sharply. These stocks are priced for perfection. Second, inflation could resurge from excess fiscal stimulus in the US, from geopolitical energy shocks, or from emerging market dynamics. And third, this is a fascinating wildcard. The Supreme Court could strike down Trump administration tariff measures, which paradoxically might weaken the dollar as markets price in fiscal uncertainty.
Explain that to me.
If the court limits the administration's trade policy tools, markets might worry about how they'll achieve their economic goals and fund their priorities. That uncertainty pushes up term premia in bonds and potentially weakens the dollar. Now, on interest rates, this is critical. Neutral rates have been rising. The US neutral rate is estimated by some to be higher than 2019 levels because of demographics, debt dynamics, and productivity improvements.
So the Fed's less dovish than people think?
Precisely. The consensus expects more cuts in 2026 from the Fed, but that could be stimulative relative to the new neutral rate. The terminal rate where policy is truly neutral is probably higher than market expectations.
Equities, though, Wall Street seems pretty bullish.
S&P 500 targets call for a 12 to 14% upside. The bull case rests on earnings growth broadening beyond tech, pro-cyclical policy support, and that AI adoption story. But it has been noted there's been a post-election frenzy of leveraged buying of US stocks, which raises the odds of a tactical correction in Q1. When everyone's leaning the same direction, watch out.
Europe's story is different, I imagine.
Europe's dealing with Germany's continued weakness, still the sick man of Europe. But there's hope that a new German government delivers fiscal stimulus and defense spending, which could boost the region. The ECB is expected to stay on hold. European equities are cheap relative to the US, so there's potential for a catch up trade if the fundamental picture improves.
And Japan's going the opposite direction, hiking into 2026.
Japan's finally normalizing after decades of deflation. It's a delicate operation. They need to normalize without killing growth. JGB yields are forecast to rise, which seems modest, but it's high for Japan. The yen should appreciate as rate differentials narrow with the US, but it's not a straight line. Market positioning and intervention risks create volatility.
Let's talk currencies and commodities. What's the dollar outlook?
The dollar is expected to remain broadly firm against most major currencies. Looking at the euro dollar, the consensus is bearish on the euro, targeting around 110 by end of 2026. French political risks and German growth are weighing on the euro.
What about other major currency pairs?
Sterling's expected to hold up better, around 1.30 against the dollar by year end, and actually gaining ground versus the euro. The thinking is the Bank of England will disappoint the dovish expectations and the UK economy recovers. The yen's interesting. It is seen trading in a 145 to 155 range. Unlike the Abenomics era, you've got above target inflation in Japan and a falling US Japan rate spread, so we're not looking at massive yen depreciation.
Commodities? Oil's the big question?
Oil's the bearish story. Brent is forecast to average around $58 per barrel in 2026, WTI around 54. The bear case is even more dramatic. Without intervention, you could see Brent falling well below 50s in 2027. The issue is supply massively outpacing demand.
Gold, I know that's been a big story. What's the outlook?
Gold expectations are still bullish. The forecast is pushing toward $5,000 per ounce in 2026. Some are even calling it the ultimate safe haven and a currency debasement hedge given US stagflation risks and fears of fiscal dominance over the Fed. The rally is supported by continued central bank buying and increased investor demand over debt sustainability and policy uncertainty concerns. The advance continues.
Copper as the economic barometer?
Copper's highly bullish. Forecast is rallying toward $12,500 per metric ton in the first half of 2026, averaging around $12,075 for the full year. The story is acute supply disruptions and inventory dislocation. Mine supply growth is only 1.4% in 2026 due to significant disruptions, while demand from power utilities and data centers remains resilient. It's a tight market getting tighter.
Let's talk emerging markets, starting with China since it drives everything.
China's the key variable for 2026 global growth. Consensus forecasts are 4.5 to 5.0% GDP growth, but we've heard stimulus promises for months, and the data keeps disappointing. Property stress continues. Consumption is weak. They'll need much more aggressive fiscal support to hit even the low end of that range. The yuan is expected to appreciate to around 6.7 per dollar by end 2026. That's based on robust exports, stabilizing US China relations, and a high current account surplus.
Are investors buying the China story?
It's divided. Some are overweight Chinese equities, betting the stimulus eventually works and valuations are attractive. Others are underweight, believing we're in a multi year deleveraging cycle where repeated stimulus just creates more debt without generating sustainable growth. It's one of the big debates for 2026. Is China recovering or Japanifying?
India seems to have momentum.
India is one of our favorites. Growth is forecast at 6.5 to 7.0%, and inflation is well controlled. The rupee stays relatively stable despite its latest foray above 90. But there's a catch. Equity valuations are stretched. Indian stocks are priced for continued perfection. Any growth disappointment or global risk off sentiment triggers a sharp correction. The fundamentals are strong, but the price you're paying matters.
Turkey, are they actually maintaining orthodoxy this time?
Turkey's made genuine progress in rebuilding central bank credibility. Inflation is declining from absurd levels. The current account is improving. The repo rate is forecast at 29 to 30% range by year end 2026, down from current levels but still high in real terms. The lira depreciates in an orderly fashion. But, and this is always the question with Turkey, can they maintain orthodox policies through 2026 without political interference? Recent history suggests caution. Still, we like the carry trade.
South Africa just had a successful bond sale.
South Africa's got a decent carry story and some post election political stability. The SARB can cut rates to 6.25% by year end, maybe 6.0%, as inflation stays anchored. The Rand benefits from better commodity prices and gradual reform progress, but structural growth constraints cap appreciation. They're not solving their problems, but they're managing them reasonably well given the constraints.
Central Europe, Poland, Czech Republic, Hungary. What's the hierarchy there?
Poland's the standout trade. Their local bonds are the top duration opportunity for 2026. Wide spreads, high term premium, room for rate cuts as inflation normalizes. The NBP cuts to 3.50 to 3.75%, and growth outperforms at 3.7% on improving EU fund flows. Czech Republic is largely done with easing. Their cycle's complete. Hungary's the political story with April 2026 elections. Smooth election, you get rate cuts and forint strength. Messy election, you get volatility and caution.
And Egypt remains the high yield gamble?
Egypt offers spectacular yields, but comes with a decent mix of risks. The central bank's been cutting aggressively and has room to go lower. But fiscal fragility remains. The IMF program needs to stay on track, and external shocks could derail progress quickly. It's a carry trade for investors with high risk tolerance and the ability to get out quickly if things deteriorate. Not for the faint of heart.
All right, before we close this outlook discussion, what should we be watching next week?
Next Wednesday is the Fed meeting, and it's crucial. A 25 basis point cut is virtually certain. This completes the risk management easing phase. What matters is the statement language and especially the dot plot projections. The Fed's expected to signal a January pause by mentioning the extent and timing of future moves.
The dot plot shows where Fed members think rates are headed, right?
Exactly. This is where internal divisions become visible. You'll likely see at least two hawkish dissents preferring to hold rates, probably Schmid and Musalam, and definitely a dissent from Moran wanting a bigger cut. Hardly credible. The critical question is the 2026 projection. Different banks are forecasting different outcomes, which tells you the uncertainty is real.
What will Powell emphasize?
Powell will walk a tightrope. He'll say decisions depend on incoming data, Policy remains stimulative even after cuts, since real rates are below neutral, but he won't commit to a specific path. Recent inflation data has been sticky, particularly in services. The Fed cannot declare victory on inflation. They're just managing risks on both sides of their mandate.
Other central banks next week?
RBA and Bank of Canada both hold steady, 3.60% and 2.25% respectively. UK releases October GDP, which should improve marginally as car production bounces back from that cyber attack disruption. China's November trade data will show if the surplus widened on higher exports following the temporary US China trade accommodation.
So plenty to keep us busy even heading into the holidays.
Markets are relentless, Alex. They don't care about our holiday plans.
Remember, everyone, we do not give investment advice. For that, please consult a professional. Thanks for tuning in to this special 2026 Outlook edition of Economic Insights. We'll be back in the next year.
Take care, everyone.